Hello, let's talk about the major crisis that has hit the banking industry. Banks are facing significant trouble due to the questionable actions they have taken. Moody's, a renowned credit rating agency, has downgraded 10 small to mid-sized banks in the United States. Wells Fargo, JP Morgan, and Citibank have written off approximately $4 billion in bad loans. Just yesterday, the reverse-repurchase market experienced a staggering decline of $65 billion. And on the 24th, it plummeted further by $100 billion. These occurrences indicate that we are facing a liquidity event of unprecedented magnitude in American history. It is vital to pay attention to what is happening with gold. Have you noticed that gold prices have reached all-time highs? Furthermore, countries are accumulating tons of gold. In fact, central banks bought the highest amount of gold last year since the World Gold Council started tracking it in 1950. Even billionaires are joining in. To truly understand the situation, we must connect the dots. The looming liquidity event is going to be monumental, and it is imperative that we position ourselves accordingly. In this video, I will provide a detailed breakdown of the current situation. I want to share with you a tweet that garnered immense attention, with nearly 600,000 views. It presents insightful points that shed light on what is happening. The key is to closely monitor the actions of major banks such as JP Morgan, Wells Fargo, US Bank, Truest, Chase Bank, and TD Bank. The concerning actions taken by these banks are indicating that they anticipate a calamity. For instance, TD Bank recently fired 3,000 employees. Why would they do this? The answer lies in their knowledge that something significant is about to hit the fan. This video will delve deeper into these issues for you. There has been a significant decline in reverse repo operations, with a drop of over $100 billion reported today. Reverse repo involves money market mutual funds and banks depositing excess cash into highly liquid U.S. Treasury notes. This allows them to receive an annual percentage rate, APR, of 0.05% in overnight loans in exchange for Treasury bills. However, with the Federal Reserve implementing new initial margin requirements, the minimum capital level required by top U.S. financial institutions has increased. As a result, banks now have less capital available to fulfill margin collateral requirements. This situation could potentially lead to a fire sale of assets if banks are margin called by regulatory bodies or hedge funds and family offices, to which banks lend shares and cash. These developments indicate the beginning of a liquidity crisis. It is concerning to note that the Federal Reserve has only unwound 10% of its $2.7 trillion worth of mortgage-backed securities. Additionally, the housing market is experiencing a correction, with new home sale prices declining by 20% over the past year, and existing home sales dropping to levels not seen since 2009 during the financial crisis. Pending home sales in October have reached their lowest level since tracking began in 2001, suggesting a significant downturn in the housing market. Banks currently hold a substantial amount of residential and commercial mortgage-backed securities, amounting to over $719 billion for the top 4 banks. Of particular concern are Goldman Sachs, with 45% of its deposits uninsured by the Federal Deposit Insurance Corporation, FDIC, and JP Morgan Chase, with 55% of its deposits uninsured. It should be noted that the FDIC can only cover 1.78% of all deposits, regardless of whether they are secured or unsecured. In times of financial turmoil, the repercussions of these figures become evident. In the current situation, it is likely that the top executives will receive financial assistance, while the rest of the population will bear the burden of the crisis. There is a reliance on a federally funded bailout, which will be funded by taxpayers, despite the looming threat of recession, stagflation, and the worst economic downturn the country has ever experienced. The Ponzi scheme that has been exacerbated by the excessive money printing and bailouts given to financial institutions in 2020, following the collapse of the RRP on September 19, 2019, is a significant contributor to the monetary system's downfall. This Ponzi scheme will inevitably impact the global economy and our personal finances, although its effects may not be immediately visible, much like the inflation of the past 2 years. Looking at the current situation, one cannot ignore the rise in the price of gold, reaching $2,090 per ounce. Despite potential short-term fluctuations, it is believed that gold will perform well over the next few years. As more countries and individuals seek to protect themselves financially, investing in precious metals such as gold
is seen as a safe option.
China's massive gold buying spree further emphasizes this trend. Historical evidence supports this belief, as gold has shown resilience during past financial crises such as the Great Financial Crisis, the dot-com bubble, and the economic troubles of the 1970s. Prominent investors like Warren Buffett, Paul Tudor Jones, and Sam Zell have also shown confidence in gold by purchasing it. When observing the banking sector, it becomes evident that changes are occurring. Major U.S. banks, such as Bank of America, Morgan Stanley, Wells Fargo, and Goldman Sachs, have experienced declines in stock prices and may make further changes within their institutions. It is possible that in the face of a liquidity crisis, banks will increasingly turn to technologies like artificial intelligence to streamline their operations and cut costs. As consumers face tighter financial conditions, there will likely be a decrease in loan applications for auto loans, residential home loans, personal loans, and business loans. Consequently, banks will continue to reduce staff and cut expenses. For instance, Citigroup plans to eliminate approximately 10% of its workforce, equating to around 24,000 employees, through its new project, Bora Bora. Just a couple of days ago, there was an announcement that TV Bank is planning to lay off a staggering 3,000 employees. This news is not to be taken lightly, especially considering that this comes on the heels of the 5 largest banks collectively eliminating 20,000 positions so far this year. Initially, the revelation of these job cuts was deemed as breaking news, but within a mere 45 days, the number of job losses doubled. The addition of Citi and TV Bank has pushed the total to an alarming 50,000 lost jobs. But what does all of this have to do with the reverse repo market? Well, it turns out that this is just the beginning of what many banks are planning to do. They are aiming to reduce excess expenditures and tighten lending practices to a degree we have never witnessed before. While it is true that banks tightened their credit conditions back in 2008 to 2009, the current scenario is entirely different. The level of risk and exposure they are facing, particularly in refinancing commercial real estate in 2024, 2025, and 2026, is unprecedented. If we take a moment to consider the scale of this crisis, it becomes evident that we are approaching a tsunami-like situation. There is a massive $2 trillion worth of corporate debt that needs to be refinanced within the next year. This, coupled with the widespread need for office space nationwide, paints a dire picture. Some individuals may naively believe that we are headed for a soft landing, but the truth is far from that. Consumers are financially stretched to their limits, and so are the banks. Everything is teetering on the edge of a cliff. Despite the bleak circumstances, I personally believe that this crisis presents a remarkable investment opportunity. However, we must also acknowledge the concerns raised about the potential rug-pulling actions of hedge funds. If hedge funds, some of which hold billions of dollars in cash reserves, decide to make unexpected moves, the ramifications could be severe. The major banking crisis that unfolded last night raises several questions and concerns. One may wonder why certain entities would choose to pull the rug from under the financial system and acquire everything in sight. Consequently, it becomes necessary to contemplate who would ultimately benefit from such a situation. In all likelihood, the already dominant players in the market would emerge as the biggest winners. This crisis has the potential to trigger a fire sale of assets if banks are subjected to margin calls. Specifically, hedge funds and family offices, to which banks have lent shares, may be required to meet margin calls from their prime brokers. As we witness these developments, it is important to ponder the larger implications. Are we heading towards a massive liquidity event? This ongoing uncertainty has prompted an increasing number of individuals, investors, institutions, and even countries to turn towards gold and other precious metals. They perceive the writing on the wall for the US dollar and the US economy and are taking precautionary measures. At this juncture, it is worth discussing the investment opportunities that lie ahead. Personally, I believe we are on the cusp of a remarkable investment opportunity. Many individuals stand to make substantial fortunes, but it is also crucial to acknowledge that there will inevitably be substantial losses. To position oneself for success, it is necessary to adopt the strongest possible stance. This entails being involved in the right business, eliminating high-interest consumer credit card debt, maintaining an excellent credit score, continually educating oneself, and building a foundation for victory. In conclusion, the major banking crisis that unfolded recently raises significant concerns. While some may question the motives behind such actions, the reality is that the larger players in the market often emerge as the winners. This crisis has the potential to trigger a fire sale of assets if banks face